What's up, Outliers? Happy Friday. I hope everybody had a stellar week. We had a little bit of a fun end to the week with the market showing us a little bit of a downtick, nothing too crazy. That's really funny. There was a couple comments, one comment on a video, one comment in the Discord where people, you could tell they thought that this was like a moderately sizable down move, which is always interesting to me because I try to remind people that context matters quite a lot. And if we take a quick look at where the market landed this week, now, of note, this is a big red down day. There's no debate about that. If we take a look at the daily range today, it was 1.7% to the downside. And that exceeds the 90-day average daily range by almost 2 times. So volatility unequivocally did tick up today. That absolutely is something that happened today. But this is where we are. We're literally 2.17% off of all-time highs. So what I'm doing is I'm zooming out little bit by little bit to give you more and more context with this thing that we're talking about. This is a 10-year monthly. Monthly is okay for this. And then this is obviously a weekly chart that goes back, but this is where we are right now. And if you take a look at the market and people are out there saying, oh my God, the market is falling, it's crashing, here's the vols, the bears are here. There's like a million different things that I'm seeing flying around. And I think it's important to remember this context that I'm showing you is that literally the market is just off of all-time highs. It's 2.17%. Paulo says 1.71. Did I misspeak? If I said 1.7, I was wrong. It's 2.17. 2.17% off of all-time highs. So we're still literally parked at highs. So this came from a lot of different things on the day today, but we will get all of that on the Sunday live stream, getting ready for the week ahead and whatnot. That is not what the stream today is about. The stream today is about options trading basics, which is exactly what we're going to get into. So the agenda switched a little bit. For those that don't know, I was originally planning on doing navigating an options chain today, but a couple days ago I had a pretty rough bout of food poisoning. Like it put me down for like an entire day. I haven't had something like that before. So I didn't get a chance to build the materials as I would have wanted. So the agenda today is going to be more of an open Q&A. And what I did is I sourced a bunch of questions from DMs and emails that I've gotten. So we'll take a little time looking at those. And then there's a couple broader topics that I wanted to talk about just openly, right? A loose conversation to get the dialogue started. So the agenda for today is essentially that. Now, as always, I do have a quiz for you, so don't worry about that. There's always time to recap and knock out a quiz from what we covered last time. So let's start with the quiz. So this is the quiz from the session last week, which was on the Greeks. The first question I have for you is, what is the difference between first, second, and third order Greeks? I want you specifically to think about what these different Greeks measure. And realistically, as long as you understand the difference between first order and then second, third, then you're pretty much good. You have a decent idea of where I'm going with this question. And in the meantime, I'd love to say hello to everybody who's coming to hang out and learn about options trading on this awesome Friday. So we got Lauren, Paulo, Dakota. We also got Ian. Great to see everybody. Lauren says, so can you collect a dividend when you sell call options? It's a good question. It depends on if you hold the underlying. So what's the difference between first, second, and third order Greeks? Who knows the answer to this one? Any guesses? And I need to get this stuff out of my way so that we can get the handy dandy writing pad ready to go as well without knocking over my seltzer water. No guesses. Okay. That makes me a little nervous because it leads me to believe that we might not understand the Greeks as much as we might need to. Okay, so let's break the question down. What do first order Greeks measure? So first order Greeks are delta, theta, vega, and rho. Ian says second order Greeks measure the change of first order Greeks. More or less. So first order Greeks measure changes with respect to price. Okay? So delta gives us rate of change. Per 1 point move. Theta gives us, and this is premium. Theta gives us premium, rate of change per 1 day passing. Vega is the premium, rate of change per 1% change in vol, and so on and so forth. So the important thing to remember with first, second, and third order Greeks. First order Greeks measure premium impacts. Second and third order Greeks measure other Greeks. And the reason why that's important is because this is also why gamma, you'll notice gamma was not in that bucket of first order Greeks. And it's because gamma measures the rate of change of delta. So gamma is actually a second order Greek. Okay. Next question. If I sell a call, what is my net delta, gamma, theta, and vega? I just want you to give me positive or negative. So if I sell a call, is that positive or negative delta? Is that positive or negative gamma? Is it positive or negative theta? Positive or negative vega? So Ian says negative, Ben says negative. For which ones? I'm talking for each individual Greek. So maybe we'll split them out one by one so that it's easier to answer. So delta. Okay, so Big B's got us negative delta. James says positive delta, positive gamma, negative theta, positive gamma. Ian says negative delta, negative gamma, positive theta, and negative vega. Okay? So we're going to need some tiebreakers because we have some different answers. James says, oh, sell. Okay. So then there's no fully correct answer yet. Let me hide this. Big B says it's the equivalent of buying a put as far as delta is concerned. No, it's not the equivalent of buying a put. you would need one other part of that trade for the synthetic that you're trying to build. James says negative delta, negative gamma, positive theta, and negative vega. Does that sound correct? Ian beat you to it before. Lauren says delta is negative, theta is positive. Not sure about vega. Okay. So think of it this way. Now, for everybody that's listening in, to make sure I'm not confusing anybody, Ian was the first one to answer it fully correctly. So, and then it looks like James got it sorted out later. The way to think about answering something like this is just think about what the symbols would be for each of the Greeks. Now, when we're looking at an options chain, the symbols are essentially under the premise of being long that option. So right now, this is long 54 deltas. This is short $2 theta. This is long 6.55 vega. And gamma is not flat. I don't know why gamma is as flat there. Let's come in here. I don't know why gamma is all messed up. It's probably because the market is closed. It's just because the platform gets really squirrely when the market's closed. So I'm using SPY now just so that you can see gamma, which is positive 0.02. So this is essentially how you can see what the net impact of an individual position might be on your portfolio. And then you can actually aggregate all of those up. Okay. Next and last question related to the Greeks is, if I want to buy a call, I have a bullish trade idea. Should I go near DTE or further DTE? Ian says further. What other guesses? Lauren, you got me grinning from ear to ear. Fucking A, nice job. Lauren, you are 100% correct. That's awesome. It entirely depends. Steve says depends on time expected for the move. Part of it. Yeah, that's exactly correct. So Lauren is spot on. Now, a lot of times you will probably be familiar with my general preference for buying options, which is typically going a little bit further out in time. But there absolutely are instances where buying a near-dated option for a bullish play can make a ton of sense. So it entirely depends on the idea. And I'm really, really proud of Lauren for nailing that one, because this is also, it's a trick question, right? This one, I give you two choices and it's up to you to decipher that there's actually a third choice. And that was a big thing that I wanted also to put out here is in trading, you have to be ready to look for the gray area. Even though this is listed as should I do blank or blank, rarely in trading is the answer this or that. Very rarely. So yeah, I actually am pretty stoked on that. That's a completely accurate response. So nice job. Good work out of you. Sweet. Now let's get out of this quiz. Let's run through the recap on the Greeks. And obviously we already hit this in the quiz, but understanding the differences between first, second order, that's really important, because really when we start compiling Greeks together to look at composite Greeks. So when we're looking at second and third order Greeks, they matter to a degree with individual options, but these really become way more important when we're aggregating the Greeks up to the portfolio level. And it's because this is how you can start to see weaknesses, gaps, potential risks in the total portfolio positioning. Even though each individual position might be put on in a safe way or in line with your broader risk management protocols, there can be risks underlying the surface that you might not even be aware of. So that's the whole point of understanding the differences between the different orders, is because it can help you view things at different levels: trade level, composite level. We understand the impacts now of the net Greeks, whether we buy or sell. When you're looking at an option chain and you buy, when you're looking at an options chain, it's under the context of buying. And if you sell, it's essentially the inverse of everything you see there. And the reason why this question fell in the Greeks side of things is because we spent a while talking about using the Greeks as a tool to help us build positions. That's the main point I want you to take away from when we're looking at something like the Greeks, is that if you understand how to use the Greeks for information input, it can help you build smarter positions that more accurately reflect what you're actually trying to accomplish as a trader. So, solid job on the recap. Now, we have our open Q&A. So, I actually have a little bit of a question list built. So, I'm actually going to pull this in, and we can work through these together. And then what I want to do, though, is obviously integrate the questions that you all have on top of this. So I'm going to start with a couple of these for general conversation points. But as we talk about these, I would love for you to weigh in with other questions, other areas, other elements that you're interested in diving into. So the first question we have on here is, how long does it take to finally get it as an options trader? Which is a really interesting question. Now, for those that don't know, I think I put this in the Discord, but a lot of the questions here are just, I might have said it in the beginning of the stream. I don't know. I'm not all here. But a lot of these questions are sourced. Oh, I said it in the beginning of the stream. They're sourced from emails, DMs, stuff like that. So, but I think a lot of these questions represent probably the sentiment for a lot of people. Like, my guess is a lot of people in here right now probably have this same level of a question. And it's really interesting because it's kind of like any sort of skills-based assessment. If you think about how long it takes anybody to pick up any skill, you already know it's highly dependent on the person and the skill. What I can tell you is that just like we do things in the Marine Corps, in trading, it's not based on time. It's based on a standard. So the way I would think about how long does it take to finally get it as an options trader is way less as a function of time and way more as a display of proficiency. Now, the short answer to this is we literally can take a look at some really basic math to help us at least frame how long this might conceivably take, right? Because it is good to have an idea of things. So if you pop over to the website under resources, there's this tab, Do Traders Make Money? You could look at the profitability factors for different traders and how things typically work for people. But there's one element in here that's important for you to be aware of, which is this: the Dunning-Kruger effect. And the Dunning-Kruger effect, it's this psychological learning process. And the thing that I want you to really hone in on, though, is where mastery is considered. And if we take a look at the 10,000, I'm grabbing the actual published study for you guys. There it goes. So there's a study on this mastery concept. Now, I want to be very clear. 10,000 hours isn't like the actual end all be all for quote unquote mastery. You can develop mastery in something faster than this. There's also things that take longer than this. We normally throw this around because it gives you an idea. And that's why I think that this is relevant to you here, because the broader question is, how long does it take to finally get it? And we're starting from a point where we have no idea. So that's why I'm showing you that 10,000 hour level, because at least gives you a starting point. Okay, so we have that data point. Then if we go back to this one, we can see that the majority of traders wipe out within 5 years. So that's another timeline that now is actually really important to us. So this gives us two important data points now that we can at least start to reason through this. We know 10,000 hours is where we might find mastery. And we know that most traders typically wash up within 5 years. So the first way I would think about framing this is after 5 years, if you are profitable and achieving your objectives as a trader. I think that that is a probably early depiction of the timeline, but I think it's a fair starting point. It takes a while to get this stuff down. Now, just because you might not have it fully dialed in that time frame doesn't mean that you still can't be profitable. But it does mean it takes a while to pick up the skill set because there's a lot that goes into this thing. So that's the Cliff Notes version, I think, of the answer. I think if I were to think of a trader's timeline and just kind of eyeball it for, again, the masses, so just kind of guessing for most people, if we look at a time series and we have T0, so kind of like when we first start trading, and then we have T1, so thinking 1 year, and then maybe T3, and then maybe T5, and then maybe T10, and then maybe T15, and then maybe T20 plus. So here is what I consider to be, I'll use a different color. So this zone here, I consider to be the fire hose phase. This is where we're literally drinking from a fire hose, trying to understand all the terminology, getting the basic understanding of markets down and that kind of stuff. Then in here is when Dunning-Kruger is most prevalent. This is because we now know enough to be dangerous, but we still are very inexperienced and we still don't know what we don't know. This is typically where most of us make the largest mistakes. I made the largest percent drawdown on the portfolio around this time frame myself. Then I think once you get past this 5-year window, and you're operating consistently and effectively, this is where I consider somebody to be proficient. In this time frame, there's still a ton of learning going on. Then from here to here, I would call this stuff like refinement and innovate. So a lot of what you do here in this window is taking stuff that you've seen somewhere, dusting it off, and then kind of reconfiguring it to your own purposes. There then will come a point as a trader, and it can be before this. Again, these are very loose timelines. I'm essentially thinking of the average trader that's probably spending somewhere between an hour to 2 hours on this a day. which is still not an inconsequential amount of time for most people. But in that kind of timeline, it's going to take you quite a while. Because again, if you go back to what I was showing you here for actual mastery of something, and I, again, put this in there for general context, if you want to hit the 10,000 hour mark, you essentially have to focus on something for 5 hours every single day without ever missing a day for 5.5 years. So it takes a minute to get there. Assuming that most people aren't going to have that kind of time, that's why the timeline as I'm drawing it out for you guys is extended like this. It's to account for that, just so that you understand the way I'm looking at it. So from here out, it's really where you start like truly coming up with your own ideas and concepts. And then 20 plus, no fucking idea. I'm not there yet myself, so I don't know what to tell you. But right now I'm about right here. So I will report back once I hit the 2-decade mark. My expectations for 2 decades is probably going to be a lot of what I'm doing now. That is my general guess. Now, one thing I will note, and this is very dependent on how much money you have, your objectives and stuff, is somewhere in here, like this zone, would probably be, somewhere in here, this I'm trying to draw from like the 8-9 year mark, is asset diversity. So at some point, my expectation for most people, and again, this falls in line with my own path, is starting to spread into other asset classes. As you have your pile of money building up, the way that this works, at least the way that it did work for me, is I started with a very little pile of money. And then as the pile of money grew, what I would do is take like a third of it, and then I would put it into something else. Real estate, angel investing, hard money lending. For a long time, it was flipping motorcycles, buying broken cars, fixing them, selling them, those kinds of things. And then 2/3 would stay in, and then continue to do this point. And then as your stack of money grows a lot, I actually went through a phase where it inverted, where 2/3 of my money came out and it went into other asset classes, and only 1/3 stayed in the markets. And this is because I'm now very confident in my ability to produce from this 1/3 to get it back to being, again, a sizable amount of money. And fortunately, this 1/3 represents more than all of this ever was. So the main thing I want you to take away from all of this, though, is the importance of our ability to start spreading into other asset classes is actually really important, because it starts to add a lot of robustness to what you're doing as a trader. So a lot of details obviously went into that answer. The short answer, I think, would be after 2-3 years, you probably have your feet under you. After 5 years is probably when you're going to be showing at least a base level of proficiency. And then beyond that, it's way more based on your capacity to produce fairly predictable returns. If you're trading and you have no idea what the year is going to look like for you at all, then you're still a long ways off from that. Ian says also you lower the volatility of your asset portfolio, diversification is great. Sure, leave that. Yeah. And the thing is, it really depends on your objectives and what you're trying to achieve, right? Because diversification is important, but if you diversify too early, it's actually a bad thing. And the reason why is, let's say that I have a smaller account. Let's say that I'm working with a $500,000 account. If I take this $500,000 account and I start trying to split this thing into a bunch of different things, then you end up with a bunch of just small amounts of money spread across a bunch of different things. So that then if you have one of these actually produce well for you, well, it doesn't really matter, right? So let's say you put some money in different real estate deals. Let's say you keep, some of it in your trading account, yada, yada, yada. And let's say that you have a really solid year in one of those and you get a 20% return. Well, that is a really solid return. But that 20% on your $100,000 gives you $120K. Like, nobody really cares. It's a great percent return. The gross dollar amount really doesn't matter that much. So diversification has to be approached very tactically, because if instead of prematurely diversifying the small amount of money, and instead of trying to split it into a bunch of different things, and maybe instead I keep this at 400K and then maybe put 100K somewhere else to start that process if I was so inclined, then this actually is a fairly meaningful amount of money, right? Then you're at 180. So, well, I guess adding on top of that, my bad, you get 80. Then you'd be at 480. The main point is diversification is good, but I think it's broadly misunderstood. And I think people over diversify actually, as far as I see it typically, which is a really great point. All right. The next question here is, how much time do you spend trading? This is a really interesting one. And the reason why this is such an interesting question is because there's two very different parts of my brain. There's the part that is executing a strategy, and then there's a part that's just interested in markets. So the reality is the amount of time that I actually spend clicking buttons and putting on trades is minimal throughout the course of a week. Like if I were to ballpark it on a weekly basis, how much button clicking, like time spent actually like building a position to put the position on, for all the positions that go on over the course of a week, it's unequivocally less than an hour. An hour would be an eternity. So my guess is somewhere closer to maybe 20 to 30 minutes, if that, something like that. Just guessing. Obviously depends on the week and a bunch of other stuff, but the time spent actually trading for me is very little. Now, the thing when it comes to trading is, you will have heard me talk about this before, but essentially all of the work in trading is done before you trade. And that takes a ton of time. And you've heard me quote, you can go on my website and you can see how I ballpark the total amount of time that I've spent on this stuff. I just wrapped up my 18th year of trading, and I unequivocally have spent over 35,000 hours in markets, either studying, learning, or trading, like some variation of those. So I've spent a ton of time. Now, most people, when they ask this question, though, they're asking it from the context of this person, when they sent this in, they still probably believe in fast, easy money. And they're trying to see if they can get the fast, easy money. And just reading in between the lines for the question. And the reality is, and you guys already know the answer to this, it's not going to be fast, easy money. It's just not a thing. Now, inversely, very cool part about trading is that once you do have your approach built, it really is pretty easy to execute. And then it also depends on what you're comfortable with as a trader. If you're comfortable with lower touch points, higher volatility of the portfolio, you can get by without trading very much. I always share at the end of the year the performance of my trading account, but then also my IRA account. And the reason why I do that is because I don't trade much in my IRA account, and it typically performs pretty damn well. And it's really to show that you don't have to be mega involved in order to drive solid returns. A lot of it actually is getting out of your own way. So total time spent button clicking, like building trades, less than an hour a week. the total amount of time looking at markets, reading news, reading studies, I would probably put it somewhere between 4 and 12 hours a day. It really depends on the day and what I'm working on. So I think there's a wide range that can go into this, but this is also one of the reasons why I'm not really big into day trading. And it's just because day trading it can work. It's very difficult to get it to work because you're dealing with really, really short-term sentiment, which is very hard to predict. But you're also like strapped to the screen, which is wholly unappealing to me, to be completely honest with you. All right, next one. This one was from Reddit. I distinctly remember this one because I remember reading this and thinking how far off base this question was for like what they're trying to do. So they said, "Hey, how can I get to the same place as you where I can trade and make consistent money? Can you teach me your strategy?" Which is a general note for people. This is a terrible way to approach anybody with a favor. It really is a terrible way because it's so unbelievably selfish to ask this. I would never go up to a successful business owner and be like, "Hey, can you teach me everything you know about building successful businesses?" It's not going to work. I'm not even going to get any sort of conversation with them. Now, I actually go out of my way to respond to as many of these as I can because I've been on the receiving end of trying to get information and being ghosted, and I know that sucks. So I try not to do that to people. But for those that are listening to this in general, a good piece of general advice is that this is a terrible way to ask this question. It just comes off awfully because you have to think of it from the practitioner standpoint, in this case, my standpoint. This is something that I've spent an insane amount of my life force learning and building. And then this person essentially just says, "Can you teach me how to do that?" And there's a way to go about this that I think is likely to get them a better answer. So for somebody like this, if this was rewritten, now I want to be clear, this is my own lens. Somebody else that you might seek advice from might have a different perspective. But I've had pretty good success with this style of framing, which is, "Hey, it can be whatever. You know, I saw your post on blank, or I saw you talking about blank and thought it was really interesting. I wanted to know, do you have time for a 5-minute call? I would love to pick your brain on a couple questions." You're still going to get a no 95% of the time, but it at least comes across as a little bit more thoughtful. Because here's the other reality. Again, think of what, like, let's say I even wanted to do this. What would go into me teaching them the strategy? Could you imagine how much work that would be to teach somebody that? If you go on my YouTube channel, there's over 2.5 million views across hundreds of videos. Hundreds. So another thing that this just presents as is lazy, right? Can you give me the TLDR of your profession, essentially? So now all that stuff aside, in trying to coach people how to get more successful answers, I think the way that somebody can get to the point where they're making consistent money is if they go through the process of building their own approach. I think that that's so important. I was actually just talking with somebody in the Discord earlier today about this. It's the same thing in the military. The process of planning literally is more important than the output of planning, almost always, right? Mike Tyson has that great quote, "Everybody's got a plan until they get punched in the mouth." The thing with planning is that the output, the plan itself, very rarely is going to directly reflect what you're going to see. That's just the reality. But that aside, going through the process of planning is extremely enlightening. You can learn so damn much from the process of planning. So the way that you get to this point is through the planning process. And I will show you. So if I go into the Discord here, and I just want to show you some of the conversation I was having earlier with one of our members, Paulo. And so this is in the open part of the Discord. Everybody's welcome in here. And Paulo had mentioned there's a bot that I built that essentially just opens up a dialogue, right? And asks people, how'd your day go? Essentially, and since it's a Friday, how'd your week go? And Paulo responded that they're sticking to trades longer than they should, negative return on the week. That's actually a really good self-identification. That's solid. So then I ask, what's the fix? One of the things that you'll note about me is I could easily tell them what they should do to fix this. I think that literally sabotages them of a learning experience. I think the process of thinking through things is just like the planning process I was referring to earlier. The process of reasoning under your own accord with guided inputs is much more valuable than me just giving a blank answer that says you should do this. And you'll see why in a second. So I asked him what the fix is. And we went back and forth. And he was saying planning things in advance and sticking to the plan, which is actually a really, really great insight. Also something I think pretty much all of us would agree with is smart. So then I was asking, tell me more about what's happening. Because at this point, if we're saying something like stick to the plan, that then calls into the question of, do we have a plan? And if we do have a plan, do we trust the plan? So that's what I'm probing for in this. And now we have a little bit of hindsight bias. They're essentially looking back and they're saying, well, if I had done blank, then this other thing would have happened. This is really common. It's a really common bias for just about everybody, but it's the exact wrong way to analyze things after the fact. It doesn't really, ex-ante doesn't do anything for you. Because there could have been the exact other scenario where you exit the trade and then it flies in your direction even more and you could have made more money. This, I can immediately glean that we're still far too focused on the outcome of individual trades and not enough on the process. I can glean that from this exact statement. Now, the reason why this is so important is because when somebody is still so hung up on the outcome of individual trades, it tells me the underlying strategy is lacking. Because if you have a solid underlying strategy that you believe in, that's robust, that is not lacking, you naturally start to deprioritize the outcome of individual trades. So that's why I told him in this case, based on this comment, I think we're looking at the wrong thing. And then going down a couple other things, I want to show you, where is it? Here. So essentially they're saying that they're trying to trade the contraction of volatility post earnings. Okay, that's fine. That's a completely reasonable idea. And they're saying, I'm asking, okay, then how do we actually measure the movement of volatility around earnings? The reason why this question matters is because guess what the profit mechanism here? They're telling me what the profit mechanism is. They're telling me that the profit mechanism is volatility contracting after earnings. But then when I ask, how are we measuring that? We're not even measuring that. We're saying we're just seeing how the position returns. Well, that induces a bunch of other factors into the profit and loss. You're going to have delta inclusion. You're going to have theta inclusion. So there's going to be other things impacting the P&L of your actual position. You're going to have things like delta decay impacting your position. So the issue here is that we're not actually even measuring the thing that we're trying to accomplish. So guess what? This is like if I was trying to win a 3-point shooting competition, but nobody counted the number of shots that I made. Tough to fucking know if I won or lost, isn't it? Right? The point here is that if we can accurately identify a profit mechanism, we have to measure it. So in this instance, we accurately identified a profit mechanism, which is fantastic, but we've not measured it. That's a problem. This goes back to the point I made earlier of detecting a lack of underlying strategy. This bolsters that original hypothesis that I had. Then there was this. If I get 70 to 80% return, then I sell. I'm beginning to think that's too high as well. Now, another note I skipped over that I should highlight is this up here. I asked, are we doing single lots, multiple lots? And they said, well, they're doing 3 to 10 lots. Yes, that's too big. Two things. One, there's actually no way on planet Earth for me to know from the data given so far if this is too big or too small. So the fact that they're autonomously putting this in that this is too big, it tells me that they know they're actively making a fucking mistake. Because a 10 lot, depending on the size of the stock and the size of the portfolio, can be completely reasonable. It could even be undersized. But this tells me that, again, there's no underlying strategy because part of the strategy is sizing. This is saying this is too big, so we're not following the strategy. Then come down here. If I get 70 to 80% return, I sell. I'm beginning to think that this is too high as well. Guess what this tells me? This is unresearched. We're taking another guess. And guess what? We're not measuring. So it's no surprise to me that when we look at Paulo's path with this, and for those hopefully that can see what's going on here, I'm in no way picking on Paulo. You'll actually notice the people that are putting in the effort to try and learn, I will always give them the time of day like this, right? Like, I don't get much out of this, to be completely honest with you. This doesn't necessarily help me a whole lot, but I really like helping people, especially people that are trying. And I can see that from the fact that Paulo answered how the week went with an honest self-assessment that Paulo is trying. I'm always here for that. So anyways, this being a random number that we tie on and say, I'm beginning to think that's too high as well, it tells me it's not researched. Go all the way back to the first thing I said. We don't have a fucking strategy. So here's the problem. And this goes all the way back to what we're talking about here, about making consistent money. The process of building your own strategy is so unbelievably important, because if you take the time to build your own strategy, you inherently understand the landscape. There isn't the question of, I'm beginning to think this is too high as well. There isn't the question of, this size is too big. There isn't the question of, I think I'm staying in trades longer than I should. All of those fall off because it's defined. Now, one thing to note, my opinion is, as a new trader, it is so much more important to strictly follow the plan. As a seasoned trader, you get to have more creative license. You get to break the rules a little bit. For me, my trading plan is more like trading guidelines. I generally follow the core concepts of the majority of what's in there, but I always have a saying that I like to use, which is the trader has the last say. It's not the plan that I wrote out. It's whatever I'm seeing as the trader and whatever I think as the trader on scene, whatever I see makes the most sense. Now, you only get to do that once you have a demonstrable skill set. It's kind of like when you see professional athletes doing things that are fundamentally unsound, but they're professionals. They kind of know when they can get away with a little exuberance and where it might actually be optimal, based on what they happen to be seeing at that point in time. And they have the skill at that point to pivot in that way and take advantage of that opportunity. The same thing with trading. It's literally the same exact thing with trading. So the main note here is the way that this person or literally any other person can get to the point where they can consistently make money. It's when you build a toolkit that allows you to confidently trade any given market condition. The cool part is there ain't that many of them. Market goes up, market goes down, market goes sideways. Volatility goes up, volatility goes down, volatility clusters, right? That's what you got. So the really cool part about trading in general is that there's a bunch of different ways you can go about it. But the reality is you're starting from a pretty decent jump point, which knowing those different ways that the market can make money. Reese, what up, Reese? Good to see you. Casadoro says you continue to drop quality info and really stand out. You do not have enough subs. So many more should be learning from you. That's awesome to hear. Thank you so much for saying that. That kind of stuff is really encouraging because I obviously want you guys to learn as much as you can. And I want to try to help people learn. But to be honest, that's also why I think our community is right-sized. It's because the majority of traders get into the world of trading thinking it's going to be fast, easy money. And it's simply not. So that's actually why you'll see other YouTubers in general, they will essentially just try to monetize their audience by using what we all know as clickbait. But it's for the kind of people that touch those kinds of things and they have those hopes of fast, easy money and stuff like that. Our community is very specific, and it's actually our community members that taught me this. I didn't even know this, which is the people that find their way into the Outlier community typically are people that have been trading for a little bit, understand that this is actually kind of difficult, but they're interested in putting in the effort to learn. And that's naturally going to be a much smaller subset of the total trading world. So I really appreciate the comment. It's really, really kind of you to say. But I will always beat this drum. I care so much more about the quality of our community. And to be honest, I care so much more about being proud and comfortable about the information that I'm putting out than I am growing. Now, I am trying to hit 40,000 subs at the end of the year because if I'm going to take the time to do something, I need to continue to get better at it. That's just part of how my brain works. And one of the ways that I do measure that, obviously, is through subscriber count. So I definitely am still trying to grow and get better, but that's always secondary to me. And it's why, I mean, a great example of that is the video that I put out this past Thursday. I'm starting a segment on Thursday that talks about like options trading quick tips. And the video literally got 185 views. That's like an objective flop. It's a terrible, terrible turnout for a video. But the content in that video is good. And I'm comfortable with the content of that video. So the way I look at that is not, wow, that sucks. Only 185 people watch this. I look at this as 185 people got to watch something that I actually think is good, usable information. It was about volatility. So yeah, it's a really interesting problem set for me, to be honest, because you can see how and why creators turn to the clickbait stuff, but I don't think it excuses it. I think it's a perversion of morals, to be honest. And everybody has their objectives, but mine rest a little bit different. Lauren says, I didn't see that yet. I didn't know you put it out. Share it again on your community wall. Got it. Yeah, thank you. I will. I dropped the link in here. But for those that don't know, what I'm doing is on Thursdays, I'm starting a segment that's essentially, I'm calling it Outlier Trading Quick Tips. And the whole point is a lot of what I do is kind of heavier stuff. So the goal for the quick tip segment is to give people shorter videos that teach pretty dense stuff in a condensed time frame. Now, this last one, I'm not going to lie, it was a little bit longer than I wanted it to be. It was like 13 minutes. I'm trying to keep them under 8 minutes. That's the goal going forward. So Chris says, hey, Eric, do you have any videos on debit spreads for 0DTE SPX trading? I don't trade those at all myself. I don't really think that there's a lot of efficacy behind that personally. So I don't. And now, by the way, is the perfect time. If you have questions, if you have anything that you want to talk about, feel free to start throwing it in there. We're at about an hour. I'm going to go through the rest of these questions just because I don't want to leave people hanging, but I'll go a little bit quicker. Next one says, could you provide some guidance, reading material on how to get started with option trading in a manner that's compatible with a full-time job? That's a great question. I actually think that this was a veteran that sent this to me. I think grabbing options as a strategic investment and just working through that entire book. I really think that that's the easiest way to do it. The way that I would structure it in my mind is I would pretend that I'm back in college and this is the required reading for this semester, right? It's like, if you apply that kind of discipline, you can get through a pretty big book like that in a reasonable time frame. So if we take a look, this book is getting out of the glossary, getting out of the graphs, axes, which are great. So the book is 978 pages. How long is the semester? I don't even remember. When I was at RIT, we did semesters my like super senior year, because before that we were actually on quarters. So I actually don't even know how long a semester is. Like, is it no, not 6 months. How long is a semester? Anyways, I'll start doing a math problem here though, and then you guys can tell me how long a semester is. Somebody will know that. So 987. If you read 10 pages a day, every single day, it'll take you 98.7 days, right? So the point is, even a book that's 1,000 pages long, if you break it up into a smaller problem set, it takes you less than 3 months to complete. 10 pages a day it's literally child's play, right? It's literally child's play. It's just a function of consistency. Paulo says 6 months. Oh, it is 6 months. Thank you. I genuinely didn't know. But for somebody with a full-time job, it's exactly how I would start. I would give the problem set that simple of a starting point so that you can gain momentum and keep crushing it. All right, next one. This is also from Reddit. I actually didn't read this one. I was just wondering, though, is there any hope for small accounts? Not, of course, to trade full-time, but maybe one day. My day job doesn't make me much money, but I can afford to lose some for investing. Yeah, there's of course. The thing to remember with a small account is that your job with a small account is to learn the skill set. That's your job. The prospects of growing a really small account into a really big account is very low. But a lot of the stuff that you learn trading a small account applies directly to a big account. Chris says, do you still stay in touch with Newton? It's a great question. So I texted him at 21:32 last night, and then he texted me back at 06:13 this morning, and we went back and forth for a little bit. So he and I still talk, I mean, at least every week we bullshit back and forth. So yeah, I talk to Newton quite a lot. I like him a lot. Like, The thing that I like so much about Newton is it's not even from like a GameStop or a trading perspective. Now, that's one of the cool things about him is that I met him through GameStop, which is very cool. But he's so different than me. And you guys have to understand how much I love that. I love when people are different than me. They become really interesting thought partners for me. So he's very religious. I am not. I'm not religious. I'm just not anywhere near as religious. And he has like a very specific belief system with his religion. And I literally love learning about it because it's so fucking interesting. So yeah, I keep in touch with him really because I think he's a genuinely good person, but also because it's like he and I have really interesting conversations. Like it's fun having thought partners to just not even necessarily related to GameStop. He's still the dude that I go to bounce ideas off of with that. But it's really cool to have thought partners in general, just in life about different things. So yeah, for sure. How do you find the right stock to trade? This is a good question. This becomes so much easier if you have a defined strategy. And then once you have a defined strategy, if you're familiar with the Outlier strategy process, this essentially answers itself. Because based on the profit mechanism and based on the signals that fit the profit mechanism, you can scan for those signals. And essentially that's how you find it. So the problem a lot of new traders when you're trying to figure out what stock to trade is it just starts as like this really big problem that we don't know how to wrap our arms around. But the cool part is as you gain experience as a trader, it actually becomes pretty damn simple, to be completely honest with you. There's just nowhere near as much effort that has to go into place. And it stems from you naturally limit your choices based on what you're looking for. A great example of this is, let's say I'm trying to play in earnings. Going back to that example from Paulo earlier, if I'm trying to play earnings, it tells me that unless earnings happen to align with an options expiration, OPEX, that I essentially need something that has weeklies in order for me to get the actual exposure that I want. It's a natural filter that's going to knock out the most of the tradable universe. There's only like 500 and something stocks, 538 or some shit, that have weekly options. So that's how you find the right stuff to trade, is you start with something like the Outlier strategy process, which is literally just a framework for thinking. And then you define the profit mechanism, you define the signals. And then when you search for those signals that fit the profit mechanism, it's going to back you into the kind of stocks or just securities that fit the idea. What info is the most important to know? I mean, that's such a big question. It's such a big question. I think the most important information to know is the profit mechanism. Like if I had to pick something, it's the profit mechanism. Because if you thoroughly understand the profit mechanism, then the worst you can do is pick something that's suboptimal to capture it, but you still would make money in that scenario if you firmly understand profit mechanisms. So I think that's the most important thing to know, profit mechanism. Recommendation on understanding tax implications or softwares, or should I need to go to a CPA? I think if trading itself is not that complex. The reporting process for trading can be done. I used to do my own taxes. I think it really depends on your broader tax footprint, to be completely honest. So I think what I can tell you is that a CPA becomes worth their weight in gold as you make more money, unequivocally. Because the main thing is, as taxes get more complex with more components to it, the broader expertise is just so worth it. I happily pay a lot of money for really my team of people that help me, which one of them is a really solid CPA. I also think having a really good attorney that can help you, again, once you start having larger assets, it's really good to have that kind of expertise. If you're a smaller retail trader, it's just a pass-through amount, right? So if you're trading short term, you're going to be taxed at your nominal tax rate. If you're holding things longer than a year, you get long-term capital gains tax. You can attempt to hit DTS, day trading status. And if you do that, then you can elect for something like mark to market, which will change your tax profile a little bit, allowing things like wash sales. But you get a consolidated 1099 from your broker, which essentially is telling you exactly what to input. So yeah, I think if you have simple, broader taxes, you can do them yourself. If you have a more complex tax picture, then CPAs are entirely worth it. Completely worth it. And then the last one here is, why is there so little accountability for what people say on air or write, even in the finance world? The sheer amount of noise is useless / non-actionable stats. Like the SPY is down a whole 1% today due to XYZ. The reason for this is actually funny, and you have yourself to blame. That's the reality. It's because a lot of people really like entertainment. They like to be entertained. So in order to get people to click in and to watch stuff, they essentially need to entertain. So if the collective behavior and preferences of investors and traders changed so that we weren't clicking into whatever this thing is or these kinds of things, then they would change what they produce. But reality is people like it. So that's why they produce it. So yeah, unfortunately, we literally have ourselves to blame for why most reporting is done the way it is. And the other thing about it, honestly, is that there's kind of opportunity that lies within it. And it's because it tells you that the average person really has a completely different experience than what a trader is doing. And the cool part about that is you can absolutely use news cycles for tradable ideas, which is very neat, I think. But yeah, that's exactly why. The Cliff Notes version is because you, and obviously, I mean, retail traders in general like it. Unfortunately, that is the case. So those were the questions that I got submitted. I hope that just the general conversation is useful. I hope that you guys hopefully picked up a couple things in here as we, walk through a bunch of these. But I have like another 5 minutes or so. So if there's any questions that you have that you want to rock and roll through, I would love to hit anything else that you might have. More than happy. More than happy to dive in and cover it. So yeah, that's the end of this part though. Our Q&A. And then while you guys are doing that, we can take a look at the trading basics syllabus, because I actually have to update this. So today ended up being Q&A. And then these two will just move down. So the next session for next Friday will be navigating an options chain. And then we're going to get into analysis, technical analysis, and fundamental analysis. Cool. Paulo says a ticker. Sure, we can take a quick look at a ticker. Why not? Well, actually, why not is because I need to build our recap. So that's why not. All right, gang. I'm going to wrap us up here. Then it looks like we got all the questions answered. I'm going to finish the episode recaps, get your quiz set. Chris says, I'm disappointed that there are so many scammer YouTubes that try to sell you a fake course. They also have so many of those videos to sell fear on stock or markets just for the click. That is the straight up reality. And it's because I have a thing on my whiteboard over here. When I first started getting into YouTube, I really started spending a bunch of time understanding YouTube. It's the same stuff that I talk to you all about doing, right? Landscape analysis. Those kinds of things are literally exactly what I do in my personal career, right? When I'm doing stuff like this. So with YouTube, the three things that I have written on my board over here are fear, curiosity, and desire. And the reality is fear, unfortunately, works really well. And it's because people are highly fearful of a lot of different things. And people will continue to be fearful. So honestly, Chris, it's another one of those things. You really shouldn't be that disappointed in the YouTubers. You should be disappointed in your peers, the people that click the video. Because if those people don't click that video, then that video starves and dies. Because those are the people that are actually trying to make a living off of YouTube, which I understand and I respect that. I'm really fortunate in that I don't have to do that. But if I had to make my living through YouTube, because that was going to be my essential professional way to make a living, then my job as a YouTuber is to serve the audience what they want. And that's reality, is whether people overtly acknowledge it or not, it is what they want. And it's displayed through their action. Which is, I think, sad, but yeah, it's another one of those things we have nobody other than ourselves to blame, unfortunately. Kind of is what it is, eh? Now, I will say that I do think that there's room for morals and integrity. And I do think people do stretch them sometimes for the sake of getting a click. So even though I think that the audience might favor something, demand something, have a preference for something, like the creator isn't forced to do that, but they are pressured to do that if they're attempting to make a living off of this. Because this is another thing I honestly see all the time. I don't have any courses, but a lot of people will try to talk shit about courses. And they'll say, well, if anybody is successful, then they wouldn't have a course. It's such a dumb statement. It really is fucking dumb. That book that I just picked up, Lawrence McMillan, Options as a Strategic Investment, that dude's been in markets for a long time. He has a course. He has online courses. He has book. He has a trading guide, or like a guide for that bigger book. Like, the fact is, for people that spend a lot of their time and effort building expertise in something, you try and monetize it, but you also try to share it, right? That's just a natural propensity for people. The other thing that people don't understand for a lot of these other folks, again, is the incentive structure. Even if you're really successful as a trader and make a lot of money, why wouldn't you want to make money from another avenue based on the same skill set? You're leveraging the same skills you have, right? Now, one other thing I notice when people talk about that, now I want to be clear, the majority of courses that I come across are straight trash. And I really do believe that. I think the vast majority of people that are selling stuff are garbage. So I don't blame them. The overwhelming majority of those people don't belong in that kind of space. So I get it. I'm just poking at the logic, because the logic just simply doesn't make sense. The other thing that people will say is like, oh, if they know how to trade, then they would just trade and like size their positions up. There's a reality. Why do you think Warren Buffett is sitting on so much cash? He's sitting on so much cash because it's difficult for him to find things to get invested in that make sense for the size of the portfolio. It's difficult for bigger accounts. you actually start to get phased out of a lot of things that you're trying to trade. You can't actually put them on in the size that you want, because then the market starts to detect it and front run the move, especially for stuff like options. Because options, whether you believe it or not, you really care about the price quite a lot, because you're making a pretty specific bet with respect to price. So those thought processes are always so interesting to me from like a person's perspective. And a lot of things that I've learned have come from books. I've never purchased a course, to be completely honest with you, but I have taken a couple courses from like MIT OpenCourseWare that have been decent. Now, funny enough, this stuff from MIT OpenCourseWare, I actually don't consider it to be that good, but it's not bad. So it's so weird to me that people think that just information should be convenient, exactly what they want, free. It's like just a fundamental misunderstanding, literally, of the fucking world and how things work. But yeah, really, really interesting. The main thing, though, that I always remind people of is our decisions and what we choose to interact with has a massive impact on what's provided to us. So as long as people keep clicking on those fear-mongering bullshit links and stuff like that, they're going to keep making them. And it's a unfortunate reality, but it is what it is. The cool part is you don't have to click them. I essentially consume very little finance media, like very, very little. Most of what I learn from finance comes from feeds that get from wire feeds, not from like Seeking Alpha position posts, but literally from actual data feeds like this, right? So that I can see just information. I can see what's going on, why it might be going on, but this isn't like this stock could double in the next 2 weeks, right? Because I don't give a fuck about that kind of analysis at all. I will come up with my own analysis. I just need to be able to access the information to synthesize on my own and come up with ideas. So yeah, the overall finance media landscape is so interesting to me. And that's also why I think it's really difficult to find like what I would consider to be like genuine people, because yeah, a lot of people I think are exceedingly crooked and they have the wrong motives, unfortunately. Chris says, then people on social media sell the fear, saying Buffett sold all his VOO. Yeah, and all of his VOO was like what, 1% or less than 1% of the portfolio? At that point, it's like it doesn't even fucking matter. But yeah, I thought that was also hilarious, to be honest. Oh, I didn't even see this. Shit. Did you guys see this? NKLA says that on the 19th from NASDAQ that the company is going to be delisted from NASDAQ. I didn't even see that. I'm sure the stock didn't like that. Well, you can't even tell. Because, yeah, it didn't like it, but it's already a fucking penny stock. This is crazy. Believe it or not, I used to have a long position in here. Yeah, I was trading just some of these run-ups. It's been a long time since I've touched it, but that's nuts. This is a really, really interesting example of just a company that was positioned pretty well, but it just fucked it all up. Take a look at this, man. Like, the stock was several $100s and just ground down, and it's literally at 35 cents. Fucking crazy. Paula says, do you ever use whale alerts? I use unusual options activity, not necessarily whale alerts. And the reason why is because unusual options activity takes a lot of different forms and it's very contextual. But a lot of times people will see what they consider to be whales, right? Big positions. And they'll think that it means something. And it's very difficult to tell if an individual big person placing a trade really means anything. So yeah. Now, we did talk about yesterday those VIX positions that went on. Did we not? Interesting. But that's also not one individual position that went on. And I told you guys that I was following along with some of them simply because unusual options activity can be very informative. But like whale alerts on individual big trades and stuff like that, I don't really care about those quite as much, to be completely honest with you. What did we learn today? We learned a couple things. The first thing I think that we can summarize here is the typical duration and learning path for an options trader. We also learned strategy building and role of planning in trading. And then the third thing that we learned, I think I want to kind of combine 5, 6, and 7. I think these are fine. I think these two capture everything. And then I'm going to hop off so that I can build your quiz next week. As always, if you guys need anything, let me know. Be an outlier. I will see you all later.